What do you make of the run-up we've seen? Because 45.50 on the S&P 500 is pretty heady, just over halfway through the year.
But maybe this is good news, but I don't sense the kind of froth among our retail clients that you might pick up if looking at broader metrics like AAII percentage of bulls or the put-call ratio. And that may be because a lot of the folks that I talk to of our clients on a day-to-day basis are either longer-term investors as opposed to retail day traders, or they represent advisors that are on our platform that are managing money for their clients. So it's not the kind of froth everywhere that in and of itself represents a risk for the market. But many of those traditional sentiment measures do show at best some complacence here, which all else equal could represent a risk.
What do you think of the obvious move here, or a knee-jerk reaction, could be getting out of equities and into fixed income because you have such high yields? I was just talking about the 2-year, now back up to 484, which is pretty amazing. Does it make sense to you for clients to take less risk and get more return?
Well, first of all, it depends on who the client is, and with $8 trillion of client assets, it runs the gamut. And in fact, you specifically said, should clients get out of equities? I always like to say neither get in nor get out of any asset class is an investing strategy. All that is gambling on a moment in time or 2 moments in time, if you think about the get in and get out. So the all or nothing decision making in any asset class, I don't think makes any sense. And to try to cookie cutter in terms of allocation to equities, allocation to fixed income doesn't make a lot of sense because it really runs the gamut in terms of risk tolerance. And I think we do try to simplify this too much, and that's not appropriate because investing should be a disciplined process over time. I will say, coming out of last year, there was this thought that, boy, both stocks and bonds got killed. 60-40 is dead. There's no benefit that accrues in terms of having fixed income exposure with your equity exposure. That got squashed, rightly so, because I think for most investors, having that diversification, not just in equities, but onto the fixed income side of things, in general, always makes sense.
I want to pick up on that point about froth and whether there's signs of it. You know, money-losing tech companies had become a bad word in 2023, but you look very recently, and the money-losing companies are the ones that are absolutely surging. Carvana, Rivian, on the smaller scale, you've got Joby Aviation. What does that tell you about, our animal spirits starting to creep back into the market? I use Bitcoin sometimes as a measure of that. It's up 20% over the past month.
Animal spirits have to be here already. There's no creeping, right? They've run into the market.
I would fade, to use trader lingo, I would fade the move down the quality spectrum. I don't think this is the point in the economic cycle where you want to significantly sacrifice quality or profitability, to be more specific. There are times where you've got the potential for a big upturn in the economy. A perfect example of that was when, at the end of 2020, when we started to get the very positive vaccine news. And that really adjusted the trajectory in terms of the economy from continuing its recovery to really accelerating. And it made sense to go down the quality spectrum because that's often where the leverage is in terms of the balance sheet, in terms of what has been the lack of profitability and that leverage to an upward profitability cycle. I think it's premature to be making that bet. So I think you want to continue to lean into the quality factors and probably take some profits if you've seen outsized gains well down the quality spectrum.
I'm not much of a Twitterer, Liz Ann, but I was listening to Tom Keene the other day, and he referenced a tweet that you issued about multifamily units under construction climbing to 994,000 in June, tied for an all-time high that was reached back in May of 1973. The economic situation in this country still seems very strong when you look at labor, when you look at housing starts, as construction costs come down. We're starting to build more and more because there's no existing home sales out there. Do you think we're set up for a soft landing? Are you worried that the Fed is going to have to raise more?
Well, first of all, I think that the debate on recession versus soft landing misses the nuances of the fact that we've really had a rolling recession because areas like housing, but also manufacturing, a lot of the goods-oriented categories, particularly consumer-oriented goods that were big beneficiaries of the lockdown phase of the pandemic, those have gone in recession. In the case of housing, we've actually seen some recovery out of what was a housing recession. But I also think within housing, there are lots of really different dynamics in terms of the supply-demand relationship. You already mentioned the massive supply that's been coming on the multifamily side. That's a potential risk factor. But even on the single-family side, you've got the big differential between new homes and existing. High mortgage rates keeping a lot of existing homeowners in their homes, elevating demand for new homes, which are in short supply. So you almost have to think of it in three different buckets. There's the multifamily, and then within single family, there's the new and existing. And I think you're going to see divergence in terms of the metrics associated with each of those three categories. But the housing recession may be over. I just think the best case scenario for the broader economy would be better thought of as a continuation of the roll. Maybe you now have rolling recoveries and you don't ultimately get an NBER declared recession, but to say soft landing, everything lands softly, we've had hard landings in many of those segments already.
How do you put that into a portfolio vision right now? It seems like investors have to think about the Magnificent Seven and then everything else. And everything else is not as expensive as the headline would suggest. Is that appetizing to you?
Yeah, we have been saying that I think for a sustainability of this rally here, you want to see a broadening out. Maybe the best case scenario, particularly in terms of the sentiment environment, would be a bit of a convergence where you continue to see better participation down the cap spectrum in areas other than kind of techie or the grade 8, magnificent 8, magnificent 7, whatever category you want to talk about, but a bit of a pullback up the cap spectrum that might go a long way in easing some of the frothy sentiment conditions. So, if I had a magic wand and could divine what the market was going to do, that's what I think makes sense. But it all goes back to what we already talked about, which is stay up in quality. We've been very factor focused, not sector focused. This is not the kind of environment where you want to make monolithic sector calls. There is high dispersion, there's low correlation. That gives you an opportunity to screen for things like strong earnings revisions, earnings surprises, some of the value-oriented factors like strength of balance sheets, self-funding companies that are able to maintain profit margins, and focus on looking for opportunities with that factor-based approach as opposed to trying to do it with a monolithic sector or style-based approach.